Hello everyone, Robert here, and I'm going to say something that might shake up your thinking. If the stock market is sitting at all-time highs the way it is right now, then the question, when do I take profits from my stocks, might be missing the bigger picture. Because if you're asking that question today, you might be sitting in a casino that's about to close its doors and you're debating whether to cash in your chips for tickets to the same casino. Now, before we dive deeper, a quick request. My analytics show that most viewers aren't subscribed yet, so if this resonates with you, hit that subscribe button and drop Robert in the comments so I know you're paying attention. All right, let's get into it, because overnight we saw major indices hovering near record territory while bond yields continue their unsettling climb. And I know exactly what that does to your mind. It triggers that voice saying, this feels like a top. I should sell. I should lock in gains. I don't want to lose everything. And look, that voice isn't irrational. It's conditioned by decades of buy low, sell high advice, decades of believing stocks always come back. Decades of trusting that the system will rescue you with another bailout or another round of stimulus. But here's the question I want you to sit with. What if the thing you're measuring your portfolio against, that dollar figure on your brokerage screen, is itself becoming unreliable? What if the goal isn't to accumulate more digits in a database, but to convert paper wealth into tangible assets before the gap between perception and reality closes violently? That's what we're unpacking today, step by step. We're going to examine what legendary investors are quietly doing with their own money, not what they're telling retail investors to do. We're going to connect that to what credit markets are screaming right now. And then we're going to answer the actual question. If you don't stay in traditional markets forever, then what's the real exit strategy? And how do you know when it's time to make that move? And yes, I'm going to give you a framework you can actually use. Something simple, memorable, and actionable. So you're not just reacting to headlines or CNBC panic. One more thing before we get to the core content. Check the description below. I've included valuable resources there, including access to our premium community group and options to support this channel if you want more in-depth analysis. Now, the financial media has perfected the art of using comfortable language to hide uncomfortable truths. They don't say the system is unstable. They say we're experiencing volatility. They don't say your savings are being destroyed. They say inflation is moderating. They don't say the debt is unpayable. They say we need fiscal reform. But every now and then, someone with real money on the line drops the mask and tells you what's actually happening. And that happened recently when a billionaire fund manager, someone who manages money for sovereign wealth funds and ultra-high net worth families, said in a private conference that we're witnessing the early stages of a monetary regime change. Not a recession, not a correction, a regime change. The rules themselves are shifting. Now, I'm not asking you to worship any guru or hang on every word from Wall Street. I care about what the statement reveals. And what it reveals is that the people with the most access to information, the best data, and the earliest signals are repositioning. They're moving out of pure financial assets and into things that exist in the physical world. Here's the part that matters most. And I need you to really hear this. When you own a stock, you own a claim on future earnings, denominated in a currency that can be inflated. When you own a bond, you own a promise to be paid back in that same currency. But when you own land, commodities, productive equipment, or real businesses that generate actual goods and services, you own something that doesn't depend on a government's credibility or a central bank's printing press. That's why when the system gets stressed, the smart money doesn't just rotate from tech to energy or from growth to value. They rotate from financial claims to physical reality. And it's not retail investors doing this first. It's institutions. It's family offices. It's the people who have accountants and estate planners and access to strategies you'll never see on a financial news ticker. So if that's what's happening, let me ask you something you probably haven't considered yet. Why would you stay fully invested in paper assets when the people who write the rules are hedging against those same assets? Now, I know what you're thinking. Okay, Robert, but the market could keep going up. You could miss out. And this is where the answer becomes different from what most financial advisors will tell you. My answer is this. I'm not trying to time the top of the stock market. I'm trying to position before the bottom falls out of the currency measuring that market. Because selling stocks for cash assumes cash is the finish line. And if we're entering a period where currencies are being deliberately devalued to manage unpayable debts, then cash is not the finish line. Cash is a rest stop, or more likely, a trap. So picture this instead. You don't measure your wealth by how many dollars your portfolio says you have. You measure it by how much real productive capacity you control. Farmland that grows food, rental properties that house people, small businesses that provide essential services, energy infrastructure, water rights, timber, even a paid-off home with no mortgage hanging over your head. And the way you transition from stocks and bonds into those assets isn't by watching CNBC and trying to call the exact market top. It's by watching valuations, ratios, and systemic signals. Let me give you an analogy that'll stick with you. We are passengers on an economic ship. Most people are still partying on the upper deck because the champagne is still flowing. They're celebrating new all-time highs because the scoreboard keeps updating. They're buying more tickets to the show because the music hasn't stopped yet. But some of us can feel the ship listing. We can see the crew looking nervous. We can see the waterline creeping higher on the hull. Stocks and bonds are like tickets to events on that ship. They have value as long as everyone believes the ship is stable. But hard assets, real land, real businesses, real commodities, those are the lifeboats. They exist whether the ship sinks or not. So when do you sell your stocks? You sell when they can buy you something more valuable than a promise of future dollars. You exchange them when you can acquire control, stability, and long-term income streams. And that brings me to the practical framework I promised. I use 3 filters to make these decisions, and they work whether you're managing $1 million or 10,000. Filter number 1, the system signal. If credit spreads are widening, if bond markets are behaving erratically, if central banks are making emergency interventions, if fiscal deficits are exploding without consequences, those are red flags. That's not a time to be greedy in financial markets. That's a time to protect what you've built. Because the biggest mistake people make in a monetary transition is staying in paper assets too long and then panic selling at the worst possible moment. Filter number 2, the valuation signal. Instead of asking, are stocks expensive, ask, what do stocks buy? How many shares of the S&P 500 does it take to buy a house in your area? How many shares to buy an acre of productive farmland? How many shares to buy a cash-flowing small business? If those ratios reach historical extremes, meaning real assets become cheap relative to stocks, that's when you start converting. And here's the crazy part. Most people do the opposite. They buy real estate when it's expensive in stock terms because the dollar price feels normal. You won't make that mistake if you're paying attention. Filter number 3, the personal signal. This is the part nobody talks about because it's not sexy. Your life circumstances matter. If you need liquidity, if you're approaching retirement, if you have a business opportunity that produces real cash flow, then yes, you may need to sell a portion of your portfolio. The goal is not to be dogmatically pure while your life falls apart. The goal is to preserve wealth and improve your situation. Now let's connect this to what's happening in markets right now, because this isn't just theory. We're watching bond markets convulse in ways that should terrify anyone paying attention. Bonds are supposed to be the safe part of finance. They're supposed to be boring. When bonds start moving violently, that's a warning siren. We just saw long-term Treasury yields spike and then retreat slightly. Some analysts called that a buying opportunity. I call it what experienced traders call it, a relief rally in a bear market, a temporary pause before the next leg down. Because the math is brutal and unavoidable. When debt levels are astronomical and interest rates rise, the cost to service that debt becomes politically impossible. So what do governments do? They either default, which destroys credibility, they cut spending, which causes recessions, or they print money and financially repress savers. And all 3 of those outcomes are devastating for anyone holding long-duration bonds or large cash positions. Now add in inflation, real inflation, the kind you experience at the grocery store, at the gas pump, in your insurance premiums. Official statistics might say inflation is under control, but your lived experience probably tells a different story. And when inflation runs higher than your investment returns after taxes, you're not building wealth. You're losing purchasing power in slow motion. This is the invisible tax. Nobody campaigns on it. Nobody votes for it. But it's the most effective way to transfer wealth from savers to debtors and from the middle class to asset owners. And once you see that clearly, you stop thinking about stocks and bonds as the only game in town. You start thinking about them as one option among many, and often the riskiest option in an unstable system. Now I want to address something that matters here, because I know some of you are thinking, but Robert, what about diversification? What about staying invested? Listen, there's a place for maintaining some exposure to financial markets, especially if you're generating income from dividends or covered calls or other strategies. But in a regime change environment, classic diversification fails. Because diversification assumes the rules stay the same. It assumes correlations hold. It assumes you can rebalance into undervalued assets when others panic. But when the system itself is being questioned, everything correlated to that system moves together. Stocks fall, bonds fall, even gold dips temporarily as people liquidate anything they can to meet margin calls. That's not diversification failure. That's correlation going to 1. So if you're building true protection, you need to think differently. You separate your wealth into 3 buckets. Bucket 1, liquidity. This is cash or cash equivalents for emergencies and opportunities. You accept that it's losing purchasing power, but you need it for flexibility. Bucket 2, speculation. This is your risk capital, your stock positions, your crypto, your venture bets. You can lose this bucket entirely and still be fine. Bucket 3, preservation. This is your core wealth, your real assets, your land, your productive businesses, your hard commodities. This bucket doesn't fluctuate with headlines. It exists regardless of what central banks do. And most people get this backwards. They have 90% in bucket 2 and almost nothing in bucket 3. Then when markets crash, they're devastated because they confused speculation with wealth preservation. Now here's where that billionaire investor's comment becomes even more significant. When someone at that level says central banks and sovereign funds are changing their reserve strategies, you should ask, what are they buying instead? And the answer, if you look at the data, is hard assets. Gold reserves among central banks are at multi-decade highs. Commodity stockpiles are being rebuilt. Strategic resource acquisitions are accelerating, not because these assets are trendy, but because they represent stored value that doesn't depend on political promises. And if central banks are moving in that direction, you should at least consider following the flow. Now let's talk about the psychological trap, because this is where most people lose. Markets go up and they feel validated. Markets go down and they feel stupid. That emotional roller coaster is exactly what keeps people trapped in the system. In a wealth preservation mindset, you measure success differently. You measure it by whether you can maintain your standard of living regardless of what happens to currency values or stock prices. You measure it by whether you control income-producing assets. You measure it by whether you can weather disruption without being forced into desperate decisions. So when you ask me, Robert, when are you selling your stocks? My answer is, I'm not selling everything in a panic, but I'm systematically converting financial assets into real assets whenever valuations make that exchange favorable. I'm not waiting for permission from a financial advisor or a signal from CNBC. I'm acting on data and ratios. Now let's make this concrete with a real scenario. Imagine a future where a rental property that generates $3,000 per month in income can be purchased with 50 shares of a major tech stock, or where an acre of productive farmland costs the equivalent of 100 shares of an index fund, or where a small business generating $100,000 in annual profit can be bought for the value of your current stock portfolio. In that environment, the sell decision isn't about calling the market top. It's about saying, I can exchange paper claims for real productive assets, so I'm converting stored wealth into income and control. That's the transition. That's the moment. And it probably won't happen all at once. It'll happen in waves, which is why you don't liquidate everything in a single day. You convert in tranches as opportunities appear. Now, quick side note, because I get asked about this constantly. If you want to see real case studies of people who successfully transitioned from financial assets to real estate, small businesses, and other hard assets, check the description for additional resources. And if you find that content valuable, share it with others who might benefit. All right, back to the main thread. There's another indicator you should monitor, and it's so simple that most people ignore it. The stock to real estate ratio. Take the median home price in your area and divide it by the value of a major stock index. When that ratio falls, it means stocks are becoming cheaper relative to housing. Historically, major wealth transfers show up in these ratios. When financial assets become extremely overvalued relative to real assets, smart money makes the swap. And if that ratio keeps expanding, meaning stocks keep rising while real assets stay flat or fall, that's actually a signal. It suggests speculation is running hot and fundamentals are being ignored. And when that happens, the eventual reversion can be swift and brutal. That's why I don't want you to chase the last 20% of a bull market when the risk is losing 60% in the crash that follows. Now, I want to be clear about something because there's a trap on the other side too. And some people hear this message and think it means sell everything today and buy a bunker in the woods. That's not what I'm saying. I'm saying recognize what stage we're in and position accordingly. If you're young and earning income and building wealth, you can afford to ride out volatility. If you're nearing retirement, or if your wealth is substantial relative to your future earning power, you can't afford to lose 40% and hope it comes back in a decade. So your strategy should match your situation. But regardless of where you are, the principle is the same. Financial assets are claims. Real assets are ownership. And in a transition period, ownership wins. Now let's talk about real estate specifically for a moment, because it's the asset class most people think they understand. Real estate can be an incredible store of value and income generator, but not all real estate is created equal. Luxury vacation homes are not the same as rental properties in working class neighborhoods. Urban condos are not the same as agricultural land. Mortgage properties are not the same as debt-free holdings. If you're converting stocks into real estate, focus on properties that generate income, require minimal maintenance, and serve essential needs. Because in a downturn, luxury discretionary assets get crushed, but affordable housing, farmland, industrial warehouses, those tend to hold value because they serve actual needs. And here's a question for you, and I really want you to answer in the comments. First question, do you currently measure your wealth by your net worth number or by how much income your assets generate? Tell me which mindset you're operating from. Second question, if you were going to convert financial assets into one type of hard asset today, what would it be? Real estate, commodities, a business, land, something else? I want to understand what this community values most. And while you're in the comments, if you've successfully made a transition from paper wealth to real assets, share your story. Even if it's small, even if it's just buying your first rental property or paying off your mortgage, your experience can help others more than you realize. Now, let me bring this back to the core theme, because the message isn't stocks are going to crash tomorrow. The message is the system is being recalibrated, and when systems recalibrate, the gap between winners and losers widens dramatically. The winners are the ones who see it coming and position before the crowd. The losers are the ones who wait for confirmation from mainstream sources and then panic when everyone else is panicking. So if you're trying to time the exact top in stocks while the entire monetary framework is being questioned, you're playing the wrong game. The better game is to hold assets that don't require the system's permission to have value and wait for the system to offer you opportunities to acquire more of those assets cheaply. Now, this is where I want to give you a simple action checklist, because without it, people get overwhelmed and do nothing. Do this. Keep a portion of your portfolio in liquid assets for opportunities and emergencies. Not that. Don't go 100% into any single asset class out of fear or greed. Do this. Track valuation ratios between financial assets and real assets monthly. Not that. Don't ignore fundamentals just because prices are going up. Do this. Create a written plan for what you'll buy and at what valuation you'll make the exchange. Not that. Don't wait for financial media to tell you it's safe. By then, it's too late. Now, one more reminder. The description has links to premium resources and ways to go deeper if you're serious about understanding these transitions. And for those who want the most detailed analysis, we offer member-only content where we break down specific opportunities and strategies you won't find in public videos. All right, so where does this leave us today? It leaves us in a world where stocks and bonds are not the only options, and in many cases, not even the best options. They are tools, and like any tool, they work best when used at the right time. Right now, we're in a period where holding paper wealth feels comfortable because prices keep going up. But comfort is not the same as safety, and when the gap between the two becomes obvious, it happens fast. Now I'm going to close with one final thought, because this is what most people still don't see clearly. When monetary systems undergo regime changes, they don't collapse in a straight line with a clear warning label. They deteriorate in phases. First, confidence erodes quietly among insiders. Then, markets start sending mixed signals that confuse most analysts. Then, authorities respond with policies that create new distortions and unintended consequences. Then, almost suddenly, the public realizes the game has changed and scrambles to adjust. The question is not whether that moment will arrive. The question is whether you'll be positioned before it becomes obvious to everyone. So, am I selling all my stocks tomorrow? No. But I'm systematically converting financial wealth into real productive assets whenever the opportunity is favorable. I'm watching valuation ratios. I'm monitoring credit markets. And I'm preparing to act decisively when the crowd is still confused. If you want me to create follow-up content on specific valuation metrics to watch, how to evaluate real estate versus other hard assets, or how to structure your portfolio for different life stages, let me know in the comments. I'll build future videos around what you actually need. And if you found this valuable, subscribe. It genuinely helps more than you think. Drop Robert below so the algorithm knows this resonates, and so I know you're part of the core community here. Take care of yourself, protect what you've built, and I'll see you in the next one. Now let's slow down and zoom out for a moment, because if you're only watching stock charts and portfolio balances, you're missing the larger story unfolding behind the scenes. When people say the market is doing well, that's only half the picture. The market isn't necessarily healthy. The currency measuring that market is losing value. And once you understand that distinction, the entire conversation about taking profits changes. Most people still think wealth is the number on their investment account statement. They think wealth is the total value of their 401k. They think wealth is having a big number next to their name at the brokerage. But those numbers are denominated in currency units that can be expanded, diluted, and devalued by policy decisions you have no control over. If you've never lived through a currency crisis, that probably sounds paranoid. If you have, you know how quickly people's perception shifts. Prices stop being quoted in stable terms. People start measuring value in tangible goods. How many weeks of groceries? How many tanks of fuel? How many months of rent? The currency becomes the variable, and real goods become the constant. And that's why I keep saying, stop asking, are stocks expensive? Start asking, what do stocks buy? Because this isn't a normal business cycle anymore where you buy dips and sell rips. This is a credibility cycle where trust in institutions and currencies is being tested in real time. And the place where that credibility crisis shows up first is the bond market. Bonds are supposed to be the foundation of the financial system. Bonds are supposed to be predictable and safe. Bonds are what pension funds and insurance companies rely on to meet future obligations. So when bond markets start behaving erratically, when yields spike suddenly and then crash, when liquidity dries up in supposedly safe securities, that's not just noise. That's a structural crack. We just watched long-term government bonds in multiple developed economies experience volatility levels that should only happen during crises. Some analysts dismissed it as temporary, but temporary shocks that keep repeating stop being temporary. They become the new normal. Here's why that matters to you, even if you don't own bonds. When debt levels are enormous, math becomes destiny. Higher yields mean higher interest payments on that debt. Higher interest payments mean governments have three choices. They can cut spending, which causes economic pain and political backlash. They can raise taxes, which slows growth and angers voters. Or they can keep borrowing and hope central banks suppress yields through bond purchases, which is just money creation with extra steps. Most governments choose option 3 because it's politically easiest in the short term.